Why most IUL policies underperform? It's not the index. You did the responsible thing. You work harder. You saved more. That discipline created exposure quietly. You built income, but you didn't build an exit. And this is the trade. Pride-driven, structurally fragile. Your plan didn't fail. It just never existed. The market didn't sabotage you. The index didn't stall. Time did. Because nothing was designed to stop it. It breaks when 60 shows up early, when your kids are grown, when your body votes before your ambition does. And one day, you realize effort wasn't the missing ingredient. If it wasn't the index, what actually decides whether you get your time back? Hello, my name is Robert Balkach. I'm the founder and CEO of Black Swan Insurance Group. Since 2017, we worked with more than 20,000 families and business owners, helping them design insurance-based wealth structures that don't collapse when real life shows up. That work has resulted in over 850 plus 5-star reviews, largely because we focus on design, not product. Most underperforming IULs don't have bad indexes. They have invisible decisions baked in before the first dollar ever compounds. If you're a business owner with variable income, no employer retirement plan, and a financial life tied directly to your ability to keep producing, this isn't a theory discussion. This is about whether your current trajectory actually leads to freedom or just permanent responsibility. So if you want clarity, you can click on the link below and book a design review with our team, not to buy anything, just to see clearly whether you have a good plan to have pleasant retirement. Because what you don't design now will decide for you later. Meet Marco. Marco is 46, electrical contractor in Texas. He owns a company, runs the crews, signs every paycheck. From the outside, Marco looks successful. Strong income years, full backlog, reputation that keeps the phone ringing. But Marco has a problem he doesn't talk about. There is no real retirement plan, no employer pension, no 401k, no moment where the income machine turns off without consequence. Everything depends on him showing up. And Marco's goal isn't luxury, it's time. By 60, he wants to stop climbing ladders, stop crawling through attics, stop being the physical bottleneck in his own business. He wants mornings with his wife, weekends without calls, dinners that don't get postponed, time with his kids while his knees still work and his hands don't ache every night. But when Marco looks at his balance sheet, there is a gap. Savings exist, assets exist, but nothing produces income without him. And that's when the fear shows up. Not dramatic, just persistent. What happens if he slows down before the plan says he is allowed? Marco watched his father walk through injuries because stopping wasn't an option. He remembers vacations canceled, family dinners delayed, promises deferred to after the next job. He doesn't want that ending. But the math keeps pointing there. Markets feel volatile. Real estate feels illiquid. Selling the business feels reactive, not strategic. Marco doesn't need high returns. He needs a structure that replaces his effort. Something that creates income without requiring permission, perfect timing, or perfect help. By the time Marco turned 60, the plan on paper showed over $1 million. But what mattered wasn't the number. It was what happened after that number appeared. Because what Marco didn't know yet was this. The plan wouldn't fail when income stopped. It would fail when income started again. Point number 1. Retirement is a design problem. Most business owners don't fail to retire because they didn't earn enough. They fail because nothing was engineered to take over. Retirement isn't an age, it's a stress test. Can income continue when effort stops? Marco didn't need a market bet. He needed a system that respected variable cash flow, protected against downturns, and converted working years into future freedom. That's where Index Universal Life entered the conversation. Not as an investment, but as a structure. Under IRS Code 7702, properly designed life insurance allows tax-advantaged growth. Under Tax Code 7702A, funding can be optimized to preserve access without triggering max status. But none of that matters if the structure is wrong, because IUL performance is engineered, not earned. And the first design mistake most policies make shows up long before retirement ever arrives. Before Marco ever reached 60, life intervened. Driving home from a job site, another driver ran a red light. The impact shattered both ankles. Surgery, hardware, months off his feet. No job sites, no ladders, no income-producing work. His kids started carrying groceries. His wife handled the calls. And for the first time, Marco wasn't the engine. He was the dependency. But bills didn't pause, payroll didn't wait, and family suddenly mattered more than growth targets. This is where most plans fail, because they assume uninterrupted productivity. Marco's structure allowed access to capital through policy loans, not as a windfall, but as a business continuity, without triggering taxable income, without selling assets after market drop, without asking permission from a lender. But the interruption exposed something deeper. Access only helps if the structure can survive being used. And this is where design either holds or quietly accelerates collapse. Point number 2, funding isn't the issue, architecture is. Marco committed $75,000 per year for 10 years, for a total of $750,000. The problem wasn't effort, it wasn't discipline, it was early design decisions that created invisible drag, debt benefit load, expense timing, and loan mechanics that assumed the perfect future. When loans began earlier than planned, the structure absorbed stress poorly. Loan interest compounded, internal costs persisted, margins thinned. And this is where most people blame caps. But caps don't determine survivability, structure does. And the real verdict didn't appear until we examined what income looked like after 60. Here's what Marco's actual illustration showed. By age 60, the policy projected approximately $1.18 million in accumulated cash value. Income of roughly $104,000 per year began shortly after. On the surface, success. But watch the sequence. By age 65, the total policy loans exceeded $600,000. By 70, over $1.4 million. By 75, more than $2.5 million. The policy kept paying, cash value kept growing, but leverage was compounded faster than flexibility. By 80, loans crossed $4 million. By 90, nearly $9 million. By 95, if he makes it that low, total loans would be $12 million. Policy didn't fail. It was predictable architecture. Because IUL performance is engineered, not earned. Marco didn't want maximum income. He wanted mornings with his wife. He wanted to coach instead of manage. He wanted to retire at 60 with energy, not recover at 70. A redesigned structure reduced internal drag early, resequenced funding, and stabilized long-term income. Same dollars, same framework, different outcome. Because the goal wasn't wealth, it was time. And time only shows up when structure replaces effort. So here's the final verdict. 10 years of funding, $750,000 committed, by design, not luck, over $100,000 annually in policy income, beginning at age 60, structured to sustain for decades, without triggering taxable income, without selling assets after market drop, without asking permission when life intervenes. No guarantees, the caps still apply, fees exist, loans carry risk, but architecture decides outcomes long before markets do. So if you're a business owner who wants to retire at 60, not just stop working later, the question isn't whether you are saving enough, it's whether anything is designed to give you your time back. So you can click on the link below and book a design review with me and my team. Calm, direct, no pressure, just to see if we can possibly help you. And remember, it's not what you earn, it's what you keep. Enjoy the ride.